Hello, this is Doug Gerlach from iClubcentral. I'm here with Russell Malley, our iClubcentral's official club accounting advisor for our investment club webinar for Tuesday, September 20th, 2016. Topic tonight is investment club member withdrawals. And I call this presentation the right way to consider withdrawals, how to handle them, how to process them. We're going to cover the entire topic of member withdrawals from investment clubs. This topic is one that we've covered in the past, but it continues to confuse a lot of people who have misconceptions about investment club member withdrawals, have trouble figuring out how to value a member's share in the club, even if you're using the My iClub or Club Accounting 3 program. So tonight we're going to take a look at the entire process of investment club member withdrawals and the thinking that goes behind each step of the way. We're going to talk about your club's operating documents and how they should accommodate investment club member withdrawals, and we'll look at the My iClub platform and demonstrate some of the tools we have there that can facilitate processing these member withdrawals. Before I introduce Russell, let's go ahead and cover our usual housekeeping. For those of you who are new to our webinar series, you don't need a microphone. You can participate in the webinar fully just by listening in on your computer speakers or headphones. If the sound or graphics at any time tonight seem to be choppy, we recommend that you turn off any unnecessary programs that may be running in the background, particularly those that may be running in your systems tray. We also suggest that you do not connect wirelessly if possible. Don't use a Wi-Fi connection. If you have a computer that's hardwired to your router, that'll deliver a much faster experience. And you can always listen using the telephone as a means of last resort, perhaps, and that will free up your computer to handle the video component of the webinar. If you have problems at any time, you can contact GoToWebinar directly at their toll-free number or on their website. And if at any point you have questions, you can use the questions box to type your question in. Russell and I are monitoring that, and we'll have time to answer your questions to provide clarification during the presentation and as well as at the end. Our handouts are available in the Handouts tab, so you can go to that GoToWebinar application. You may need to click to expand the Handouts section, but then you can download that PDF, save it to your computer, or you can print it very quickly if you'd like. Use it as a reference, make notes, have that as you follow along. We'll publish that handout with the archived webinar video after the presentation, the live presentation tonight. Our complete schedule of upcoming webinars is available at iClub.com, our website. Just click on the Learning tab for that schedule and links to the archived webinar videos and handouts. Just a few notes. Next month in October, there is no investment club webinar and there is no lunchtime stock club webinar due to my travel schedule. We won't be able to have those, but we will be conducting our Toolkit 6 user group webinar in October on Tuesday, October 4th, 2016. All of those webinars are available on the iClub website, and as well we have a new YouTube channel that you can look for. If you search for iClubcentral, all one word, you can find the archived webinars, many of them on YouTube, and we're going to be continuing to add our presentations there for you to find them easily and access those. If you ever miss a webinar, the webinar tab there has all of our archives going back now for 9 years. So we have a whole library of interactive webinar sessions that you can view that cover just about every topic related to investment clubs and the operation of Toolkit 6, how to conduct a stock study. We just cover all sorts of educational topics, and you can find those all on the iClub.com website. Now, if you also would like to follow along on Facebook, search for iClubcentral, all one word, and you can get updates there. We'll post when archived webinars are being released for viewing on demand, as well as other events that may be coming up related to all of our iClubcentral products for investment clubs and individual investors. So find us there on Facebook at iClubcentral. Tonight, Russell Malley is joining us. Russell is a longtime investment club member. He's a Better Investing volunteer at the Silicon Valley chapter. He is also iClubcentral's official club accounting advisor, so he helps with our tough club accounting questions when clubs have problems or problem transactions. Russell is the one who tries to figure out the right solutions. He writes up the instructions for the complicated merger transactions that many clubs experience. So we're delighted that Russell can join me tonight to talk about member withdrawals. So good evening, Russell. How are things on the left coast?
Oh, they're really beautiful. It's been really hot, but now it's very moderate and very comfortable. So it's been a beautiful day.
Well, it won't surpass our New England autumn, where the leaves are just about to start changing here. So we at this point, for the next month or so, get to claim to be the most beautiful part of the United States. But that's just 1 month out of the year. So you can have your pleasant weather the rest of the year long, I suppose. Our topic tonight about member withdrawals, I don't know how you feel about this, Russell, but it keeps coming up in our support queue. It keeps coming up in questions that get put to me about how to handle withdrawals, and we have clubs that go through all sorts of machinations trying to make things match up because they don't understand the process of club withdrawals. Is this something that you've seen in your many years of experience dealing with clubs?
Oh, yes. I can't blame all clubs, put it on clubs, and not knowing the tax things for investment partnerships are a little complex, and how you do the withdrawal can make a big difference. So it's good to remind people of this once in a while.
Yeah, but I think it's one of those topics that I think the more you learn about it, if you are the club treasurer or an officer of a club or even a club member, hopefully this is a resource that we're going to cover tonight, that when those of you who are here, when the question comes up about how a withdrawal transaction is handled, that you can send people over to this video and have them watch this webinar and perhaps learn a little bit about how these withdrawals the rules have been formulated and why they exist and how they meet with IRS, the IRS tax code, so that everything is legal and we're not reinventing the wheel every single time. I think when we start talking about withdrawals, it's very important to acknowledge that your club's withdrawal practices start with your operating documents. So your club probably has a partnership agreement. It may also have bylaws. It may simply have a single partnership agreement. Either way is fine. It's just a matter of how your club is structured. But a key component of your operating document is how people join the club, as well as how people leave the club. And those partnership agreements must detail how members can extract their contributions from the club at some point, either voluntarily, involuntarily, partially, or in full as a result of the death of a partner. So you need to make sure that your club's documents support the practices that your club is actually using. The Better Investing sample agreement or the My iClub sample agreement have been tested through many decades. They've been vetted in all 50 states. They are perfectly legal documents. There's really no reason that you have to make significant changes to them. And we're going to talk about those operating documents tonight and why those provisions for withdrawals are the way they are and how they are put together and relate to that sample partnership agreement. Now, there are some best practices for withdrawals that's very important, that when the topic comes up and people want to know why we're your club is handling withdrawals in a particular way, it's very important to acknowledge these best practices. And the first is that you never deviate from the procedures that everyone has agreed to when they sign the partnership agreement. If you start making changes to the way that you do things that aren't supported by your club's partnership agreement, that's when you can get into sticky legal territory. If some member becomes disgruntled or feels like they haven't been paid properly, and they can prove that you didn't abide by the agreement that everyone had put their names to, that put their signatures to, then the club can be in a little bit of a legal limbo there. I also believe that it's not fair to limit members' ability to withdraw. Some clubs like to put restrictions in place and try to say prevent members from taking capital out of the club, making sure that they are committed to the long term. Often these are kind of counterproductive. If you have a rule in place that says that members can't withdraw once they join for a number of years, you're just going to end up with people who don't participate, and if they lose, it would just be better off if someone has lost interest to let them extract themselves from the club and not have to continue to service that member and bug them about coming to meetings. It's much better to not have those kinds of distractions, for instance. And after all, it's their money in the club, so they should have the freedom and the ability to pull money out if they need it, particularly in the case of hardship. That would be, I think that's really unfair to limit someone's ability to get money out of their investment club partnership in the case of difficulty, financial difficulty, or other sorts of hardships that they might be experiencing. I also believe that we don't need to penalize members when they withdraw. This is a legacy going back to days when the commissions that a broker might charge an investment club to sell a security might be 2 or 3%. Today, that's very uncommon with flat rate, discount online brokerage firms. Commissions are so low that it's really not very fair to penalize members to withdraw above the actual costs that may be incurred. So yes, have them pay the commission to sell stocks to raise the cash to pay out their withdrawal, but we don't need to penalize them any further in the case of a withdrawal. And if large numbers of your club continue to want to pull money out, maybe that's saying something about the way that your club is operating and the success of your club portfolio, that there are some other issues you need to look into instead of trying to force a framework that is just not working. It's also important to be timely in processing withdrawals, and also to, again, don't let withdrawing members dictate the terms. There are advantages to transferring securities in many situations, so we want to make sure that the club and the remaining members aren't put into situations that put them at a disadvantage. So the withdrawing member may not want to get shares as part of their withdrawal, but it may be in their interest and it may be in the club's interest to do that. You can certainly take into account a member's preference for cash or securities, but you shouldn't allow them to dictate the terms. Withdrawals should be processed in a timely manner. Again, the legacy going back, again, 40 or 50 years in the investment club movement in the United States, it was much harder to transfer securities. You needed to get stock certificates. They had to be signed and authorized and sent to the transfer agent. It was much harder and took much more time than today when transfers are electronic and can be accommodated very quickly. So there's not a whole lot of reason to build in a long period of time when someone says, I need to withdraw fully or partially from the club, to make them wait for that payout. We can streamline things and be very timely, and we certainly shouldn't build in long periods. And if we have periods built in, we should adhere to those periods in our partnership agreement. And then finally, the club accounting software has been tested. It works. My iClub and Club Accounting 3 have been used by thousands of clubs for many years. We are calculating withdrawals on a regular basis. There have never been problems where the way that we handle these withdrawals are creating problems for the IRS or for clubs. So let the software do the heavy lifting. Let the software present scenarios and make suggestions and do the calculations, and don't try to circumvent the values that the software is calculating for those withdrawals. So having said that, let's now talk about withdrawals. There are two ways that members can withdraw. One is an involuntary withdrawal. That's when you kick somebody out of the club. And the other is a voluntary, when someone needs to leave the club either fully, that means they're not going to be a member anymore, or partially, that means they need some of their capital out of the club. And then the third method of withdrawal is in the event of the death or often the incapacitation of a member, which would be a full withdrawal. So that's the case where someone is no longer able to participate in the club, and so that is treated like a full voluntary withdrawal in the case of most partnership agreements. But we'll talk about that. And then there are ways that members can be paid. One is you give them the cash, you write them a check, and it's taken care of. But in many cases, it's more advantageous to transfer shares of stock. And it may be that you can simply transfer shares of stock and cover the withdrawal. More likely than not, there will be a transfer of shares plus some additional cash. But there are advantages and disadvantages of each method that you may want to consider. And doesn't necessarily mean that it's more complicated or more cumbersome for the treasurer or for the investment club or for the withdrawing member once you understand how all of these methods work. So let's talk about involuntary member withdrawals. There's a lot of psychology that goes into handling the involuntary withdrawal of a partner from your partnership. The sample terms in the sample agreement for involuntary withdrawal state that any partner can be removed by agreement of the majority, that you've got to provide written notice when someone is up for removal, because they have to have the ability to defend themselves, and the removal when it becomes effective, when everyone votes that yes, this person should be removed from the partnership, then it just becomes a full withdrawal of the partner, and it's treated like that. The vote of the partnership, the majority vote, if it passes, is considered receipt of request for withdrawal. So why would the club remove a member? Sometimes somebody moves away and they're no longer contributing to the club, and they're simply, haven't done a withdrawal themselves, and they really aren't interested in being a member, and it's apparent. That's probably the most common reason. Other clubs have a little more stringent policy about participation. So when members stop showing up, stop paying, putting the money in, stop doing the work, that can be another reason. Sometimes it's just it's not working out. It's not you, it's us, and the club decides that a certain member is just not a good fit. Maybe that member is resisting and creating problems. And so you would remove a member that way. Once you've had that vote, we follow the process of a full withdrawal, so we'll talk about that in a minute. The death or incapacity of a member, the sample terms say, in the event of death or incapacity of a partner, receipt of notice of death is notice of full withdrawal. And so that's a pretty broad statement. It doesn't require that you get a death certificate from the county coroner or have an obituary from the newspaper. It may well be that you do have a death notice in a newspaper that you can hold up. It may be that the next of kin contacts you and says this member has passed away, and that would be fine. There doesn't have to necessarily be a written notice, although you probably want to, validate any hearsay or rumors before you presume that someone had passed away. Occasionally, there are clubs where the members aren't as socially connected, and there have been some odd cases where members pass away and no one knows how to reach the next of kin. They're aware of the passing, so there may be some investigative work there. It's always good for the club to have an emergency contact for the members, or a sort of list of next of kin. Have every member be able to provide that, so you know who to deal with in the event of some of these circumstances. Now, when we're withdrawing a deceased partner, this is processed according to your club's full withdrawal procedures. So there's nothing different that you do for a partner who's passed away than you would do for any other partner who is fully withdrawing. The process is exactly the same in either case. And this is the thing that trips up a lot of club members, is if the check is payable to a partner. Some people want to make a check payable to the next of kin, so they'll write it to the spouse, or they'll say we should write it to the estate of the partner name. That's fine as well. But the best process is to simply write a check to the partner's name and deliver it to the next of kin. Don't worry about getting fancy. Don't worry about who the next of kin is, and write the check in their name. The idea here is that we're trying to keep things simple, and we're trying to figure out the best way to handle things without creating problems. The problem, if you presume that the spouse is the person to whom the proceeds should go, and you write the name you write the check in the name of the spouse and deliver it to them, is that depending on your state and depending on the deceased will and depending on a whole lot of other factors, that could be a wrong assumption. If that assumption's wrong, you're on the hook because you still owe the money to the estate. So to avoid that and keep things simple, you simply write the check to the deceased partner's name, because when someone dies, it's not like all of their accounts suddenly can't accept. There are all sorts of accounts that got to be closed and money that's got to be transferred. So the estate of that deceased partner will be able to handle this as well. In the case of transferring stock, that's also fine. You can transfer stock. You may decide that it's too complicated, but it may be that the deceased estate is handling brokerage accounts and different stock accounts and retirement accounts, so it may not be a hardship for them to accept transferred shares. Again, if it is, or if you're having trouble connecting with the deceased family to make these kinds of transfers happen, hey, then make it easy on yourself and just do a cash withdrawal. And cash may certainly be the easier option. Russell, Don has a question. What about a partner who passes and has listed a trust or is a member, has become a member of a trust? What happens in that case?
Oh, for tax purposes, the trust and the member are the same for tax purposes. My wife and I have a trust, and the trust pays taxes as our personal income's the trust income, and we just file as individuals. If the member is listed as a trust, you can do either one. Just make it out in the member's name, or if you have the full name of the trust, make the check out into the name of the full name of the trust. And either way, it's really not the club's responsibility to figure it out. It's just to get it to the estate. Your responsibility is to get the money to the estate, and it's the executor and the others doing the estate to figure out how it's dispersed from there.
Yeah, I believe the sample partnership agreement allows for the establishment of a living trust and allows members to transfer their partnership interest to a living trust. And the reason that that is accommodated is because, as Russell says, it's the tax status doesn't change with that kind of a transfer. And so it's not at all uncommon as part of estate planning that a member may want to move their club assets into that living trust prior, at some point prior to their eventual passing. And so that makes it a little easier. Susan asks, how do we handle the incapacitation of a member? How do you determine if someone's incapacitated or what is the factor or factors that would lead a club to elect to withdraw someone on that basis? I think that obviously we're thinking of we're thinking of situations where the member is not functionally able to take care of the tasks that members are expected to take care of in the partnership agreement. And so again, it's pretty vague in the partnership agreement. Certainly, there are some situations that would be pretty apparent if someone was institutionalized with dementia or Alzheimer's or something like that. At that point, again, it would make sense to probably make sense to consider removing that partnership. Again, I think you would be in contact with the member's family and trying to make a determination there. And the idea would be that instead of demanding the family prepare some letter and have it notarized or delivered by someone with a power of attorney in order to extract this member's interest from the club, that the club can take action on its own under this clause and just facilitate things. So again, you can see that the possibility would be there for the club to withdraw someone who was somehow not functioning 100% or was functioning at a level that was detrimental to the club. But that's not really the intention. I think it's there to help the club through a difficult situation on a case-by-case basis. And again, it's pretty rare, I think, that this is an issue. And again, my hope would be that you would be working with the member's family in order to facilitate that kind of withdrawal. All right, let's talk about voluntary member withdrawals. This is the simple case where I'm in a club and for whatever reason, and it can be a good reason, it can be a bad reason, but I decide that I want to take some of my money out of my investment club. I remember in my first investment club, we had a member of the club who worked for a big media company in New York City, and they had the option at the end of the year to exercise options and buy shares of stock at a very advantageous price. And so as part of their investment portfolio, they realized that taking money out of the club account and using it to buy shares of stock that were immediately worth a whole lot more made a whole lot more sense than just keeping them, than finding other ways to raise the capital to make that purchase. So that was something, one of the first voluntary withdrawals that I had to deal with. Other times, if you're paying for kids' college education, it may be something that you would tap into. The money is there for your long-term savings goals. So that's why I believe that voluntary withdrawals should be allowed. After all, we're not just saving for the purpose of saving, we're saving for particular needs. The terms in the sample partnership agreement say that any member may withdraw in part or fully. Partner withdrawing shall give notice in writing. The written notice is deemed received at the first meeting at which that written notice is presented. You can accept email if you choose. You can be hardcore and say it's got to be a written letter signed and delivered. You can accept fax. That's really up for your club to determine what constitutes notice in writing. If the notice is received between meetings, then it's considered accepted at that next meeting. And so now the next point is, how is that person's interest in the club valued? What's the policy by which it's valued? So we've got meeting number 1. The letter is presented to the club. The terms here say that the next meeting is the meeting by which the membership is valued. So it's not the meeting at which the member comes in and says, I need to withdraw $5,000. It's not that meeting, it's the next meeting that determines the valuation there. And then the partnership will pay in accordance with the terms of payment. So I mapped this out because it is a little complicated for people to kind of think of. So you've got a meeting coming up. Let's say it's this Friday night, there's a club meeting. And today a partner has contacted the president and said, I want to make a withdrawal. Okay, so there's a letter. It's in writing. The president has it at the club meeting on Friday night. The club accepts that withdrawal. Again, there's nothing that you have to do. The president says we've got a request for a partial withdrawal, and the club can start to think then about the payout method. All right, do we have cash? Do we need to transfer shares? Do we need to sell stock? Start to think about it. They don't need to make the decision at that meeting, but they do need to start thinking about how they're going to handle it. So in a month, so here we are in October at the November club meeting, that's meeting number 2. At that meeting, the value of the withdrawal is set as of the valuation statement for that meeting. All right, so there's been at least 30 days here, and again, that kind of puts a little bit of an obstacle in place for people who might want to use the club as an ATM, just withdrawing cash, because there's a time period here. The time is meant to help the club figure out how to take care of that withdrawal if they need to raise cash or what actions they might need to take. So that's at meeting number 2. And then meeting number 2 plus 1 day is the transaction date. That's the way that we suggested. The treasurer enters the withdrawal in the software a day after the withdrawal valuation date, and then will transfer shares and writes checks as soon as possible or in accordance with the terms of payment section of your partnership agreement. And then the standard is 10 days, so within 10 days of that valuation date, the members should be paid off. So in a worst case scenario here, a partner requests a withdrawal the day after a club meeting. That's when the letter arrives. Well, it goes to the next club meeting, so that's roughly 30 days. It's presented at that meeting, and then 30 days later, at the second meeting, it's valued, and then 10 days later, the member is paid out. So in a worst case scenario, it's about 70 days from the time that someone sends the letter till the time that they should be receiving their payment. So that's the way that these valuation dates and announcement dates or transaction dates should be thought of in terms of the sample partnership agreement and how you process the transactions in the MyIClub and Club Accounting 3 software. I feel pretty strongly about this 10 business days from the payout date. And that doesn't mean that they have to, if you're making a stock transfer, it doesn't mean that they have to receive that stock within 10 days. It just means that all the paperwork's been done, the brokerage firm's been notified, the process is in the works. If the brokerage firm takes 2 weeks, that's something else altogether. One thing that people often one problem that people often have is that they see this period here between the withdrawal announcement date and the payout date, right? So this period here between these last two steps, and maybe their club, instead of 10 days, has 30 days, right? Right, so that they're using a different model. Right, so they say you've got 30 days to pay out the member. Well, the problem is that that's a month later, so the valuation here can be changing quite a bit between meeting 2 and the eventual payout over here, and so a lot of clubs get worried about that and think they need to readjust the valuation to accommodate the period here, especially if you're transferring shares between the valuation date and the payout date. And the thing is that the member doesn't have to receive the shares in order to be the owner of record. Right? And so as of the valuation date, the announcement date rather, the transaction date, that's the point at which the member comes off the club's books and they become the owner of the shares. They don't actually receive the shares yet. They may actually not receive the cash. The cash may not clear their bank account if they cash a check, but they actually receive it as of the date of payment. It comes off the club's books, and that's when they become the owner of the cash or the new shares. If you think back, again, years and years and years ago, when this process was much more cumbersome to transfer shares, for instance, there could be quite a long period there. But this is what happens anytime you buy shares. You may well receive the shares at some point after you become the owner, but that doesn't mean that you're not the owner, and it doesn't mean that the person who's selling them to you, those shares to you, has to make adjustments based on if the value goes up or down. So we don't need to get hung up on that. It's very important. We'll talk more about that as we talk about share transfers. So let's talk about the terms of payment of withdrawal. We've been talking about cash and stock withdrawals. And again, item 20 here in the sample partnership agreement gets pretty convoluted, but it says partial withdrawals can be made in cash, securities, or a mix. For full withdrawal, payment may be made in cash, securities, or mix at the option of the partners. In either case where securities are distributed, the remaining partners select the securities. It would not be fair to the partners to allow the withdrawing partner to take, all the good stocks or all of the particular kinds of companies. The club needs to make decisions relating to their portfolio and how they're managing it. So they need to make those decisions there. Partnership will transfer the value of the account less any actual expenses, so there's no withdrawal fee. The value of securities transferred will be shown in the club's valuation statement as of the withdrawal valuation date, as we've just reviewed. The club's broker will be advised that the shares are being transferred as of that date. Cash will be paid within 10 business days, and in the case of if you have longer periods there, withdrawing partner may really want the cash right away. There's a provision here that the club may pay 80% of the estimated value and then settle the balance later. So you have the ability as a club, if somebody really needs the money, to not go through the full extent of this of the timeline, and that's sort of a humanitarian kind of way of thinking about the withdrawal. And so if somebody really needs money right now and you've got the cash in the bank, write them the check for 80% of what they are expected to receive, and then settle up the balance later. and that is just something that you can do to help people out when they're in a bind. It's important when we are paying out to members that we don't unnecessarily delay the payment. We don't penalize withdrawals, and we want to be smart about paying in cash and or stock. There are some significant advantages to paying out in cash or paying out in stock in certain circumstances. Fortunately, it gets a little complicated, so we're going to try to do as much as we can to elucidate that now in this section. The circumstances when you would want to pay out in cash, when you would want to transfer shares, when you wouldn't want to transfer shares to withdrawing members. As we say, you can do withdrawals with cash stock or a mix. And we're really looking for the most appropriate method that serves the club's interests. And particularly transferring securities can be really, really good for the club and for the member, or at least not have any create adverse situations for the withdrawing member. And then we often hear of clubs that talk about a buyout, where you're buying out a member, or where another member agrees to buy out a withdrawing partner's share in the club. We don't support that in the club accounting software. It just isn't a factor there. You cannot buy someone's units at the cost that they purchased them from the club. And so a buyout really is no different from a withdrawal. So someone can put in the capital to cover the expense of a withdrawing partner, making sure they're able to pay out in cash, but the member who contributes that doesn't receive the units at a discount of any way. There's no way in the program to accommodate discounts, which is what a buyout implies when you're buying out a withdrawing member. This is a spreadsheet or a little flow chart that I created for Better Investing Magazine. It's also on our My iClub website, and it did this in 2010 to kind of step through how to figure out what's the best way to pay out a club member. So we start up here at the top with the member requests withdrawal from the club. So the first question you ask, is it a full or a partial withdrawal? If it's a full withdrawal, all right, now we're going to consider, does the club hold appreciated stock it will consider selling? So appreciated stock is stock that the club owns that have a large basis of unrealized gains. Again, the better performing the stock, the better. So this for the club. So this is the circumstance where you've got a stock that went up so much, it's an overly large part of your portfolio. You're hesitant to sell it because there would be a lot of capital gains liability there, but at the same time, it's really an unhealthy portion of your club portfolio. So if you have that kind of holding in your club portfolio, it can be useful to over here, we say, yes, we do have that, to transfer some of those shares and pay the balance in cash. Transfer some of those appreciated shares of stock, and we'll talk about why that is so useful in just a minute. And then the withdrawal is complete. If we come back up here and the club holds appreciated stock, it doesn't have any appreciated stock, the answer is no. Okay, well then we come over here and we ask, does the club hold depreciated stock it will consider selling? In other words, do you have losers in your club portfolio that you would like to perhaps get rid of, and this might be a good opportunity. I like to think of this as an easy out, a way to get rid of weak performing companies, those stocks that are clogging up your portfolio management with lots of bad news, but yet you're still kind of holding on. There's a lot of uncertainty. This is going to be the great opportunity to get rid of those, sell those stocks in order to raise cash for the withdrawal. So if that's the case, yes. So you can sell enough shares to raise the needed cash, or maybe sell some shares and have the balance from your club's existing cash. In other words, the withdrawal is complete. If you come back up here and the club doesn't have depreciated stock, it will consider selling. So in other words, you're pretty confident that all the stocks that you own are in good shape and you're not really interested in selling any of them. Well, then your option is to pay from the club's existing cash or to raise additional cash, and then the withdrawal is complete. If we start back up here again and it's a partial withdrawal, we go through the same chain here. For partial withdrawals, there's not really an advantage, and in fact there's a disadvantage to transferring appreciated shares of stock. In other words, we're not getting the benefit of delaying the capital gains that we get in the case of a full withdrawal. So in a partial withdrawal, we should really consider selling depreciated stock. And if we don't have that, then we want to raise money. So we go through these processes over here before we complete the transaction. So that this little flow chart really helps to simplify the question of how do we handle member withdrawals. And so we're able to take care of the situation based on the type of withdrawal and whether or not you have stocks that would be considering sale to raise cash. For partial withdrawals, as I mentioned here, that's when the club look at this partial withdrawal as an opportunity to clean out the club's portfolio, to get rid of the loser, underperforming stocks. You get a capital loss that you get to register right away that will apply to your next tax statement and be distributed to members, and you also get rid of that problem stock from the portfolio. We never want to transfer depreciated stock either, because then the club loses out on the chance to record the capital loss. You want the capital loss in your club. Your members can benefit from the capital losses that are distributed at year end, so you don't want to give up that capital loss. That would be counterproductive. But you also don't want to transfer appreciated stock. There may be some small advantages to clubs or members. Russell has some viewpoints on that. It might be easier to sell the appreciated stock if necessary. Russell, why do you say there are some small advantages to transferring appreciated stock in the case of a partial withdrawal?
Well, for the member, they don't get as big advantage of delaying gain because they get the club's cost basis and not their cost basis in the club. So, but if they hold it, they can delay gain. But there is a possibility at times, if they need the money right away and they sell the stock, they may get a gain or realize a gain when if they had received cash, they wouldn't have. So you have to be careful about that. And that's why resisting transferring appreciated stock, you have to be really careful about what you're doing because the consequences can go either way for the member. For the club, it's not a big deal. But for the member, you may actually disadvantage them, or they may have a small advantage by delaying a gain.
So if you don't like the person that's withdrawing, there are ways that you can mess with them, huh?
Yeah, you could. If you know they're going to have to, they want to sell the stock right away. Yeah, you could.
So of course, we would never recommend ever doing anything like that.
No.
Let's talk about full withdrawals. This is the case where if you've got stocks that have gone up in price a lot, you should consider transferring appreciated shares to that fully withdrawing member. And people get confused. They think about, well, what's the cost basis? What's going to happen to the capital gains? Well, the withdrawing member's basis in the club is the basis in their club. That doesn't change. So you're transferring the appreciated shares to them, but it's not like you're transferring the gain liability to them. So that's important to recognize. What happens to the capital gains that you would have incurred had you sold that stock right away? The capital gains don't disappear. They just get deferred. They get delayed. They're kept on the books, and then for each member in proportion to their capital count at the time of the withdrawal, everyone's got a little bit of that capital gain. And when each remaining member withdraws from the club, they're going to get their portion of that capital gain in their distribution. Well, but the thing is that if you're in your club for 5 more years or 10 more years, you're going to not have to worry about the capital gains on that transaction until way down the line. We can never eliminate capital gains, but we can delay them, which is pretty cool. So that's why this works. This is IRS code. It's meant to handle partnerships generally that have real property. If you imagine that if you had a real estate partnership and a partner wanted to withdraw, this is very hard because your real estate is not especially liquid, but you may be able to transfer title to some properties to that withdrawing partner. But if there's a cost basis, a low cost basis to that transferred property, the minute you transfer it, all the remaining partners would be penalized if this loophole didn't exist, and that might threaten the existence of the partnership. So IRS says, that's okay, you guys hold on to that capital gain, and when at some point when you leave that partnership in one form or another, then we'll collect it from you at that time. So the partnership doesn't self-destruct because one partner wants to extract him or herself from the partnership. So it's not something that is a loophole. It's really meant to accommodate investing partnerships that are not necessarily security-based. And Russell, isn't it true that the IRS looks at investing partnerships as real property?
Yeah, for normal business partnerships, any securities that are transferred are considered as cash, the equivalent of cash. But for investment partnerships, securities are treated like property. And that's why we go by the property transfer rules for partnerships rather than by security rules. Investment partnerships have that special deal that their securities are treated as property rather than cash.
Yeah. So that's all we're taking advantage of is this IRS determination, and it's kind of a pro-business determination, but we want to use it to our advantage here. In a case of a full withdrawal, if you've got stocks that are underperformers, the losers, the depreciated shares, never transfer those because you're going to give up the capital loss. You want to record the capital loss, and this is a great opportunity to clean out your portfolio. From a portfolio management basis, it's really key. It's great to have a full withdrawal, and now's your chance to sell a stock that's not performing well without hurting the feelings of the person who recommended the stock in the first place. We're just going to clean out the portfolio. If you need to pay cash, and you can raise from additional member payments if that's feasible, depending on the amount, everyone may be able to contribute a little bit extra more money. If you're super happy with the performance of your portfolio and all the stocks that are in it, and you don't want to sell any of them, then this might be something that you'd have to do, is get everyone to contribute a little extra at the next meeting in order to raise the cash that's required. Yeah, go ahead, Russell.
I have one caveat that I've seen some clubs do when they're doing a full withdrawal. It usually comes when a club is disbanding, but they've often split it into two withdrawals, and they'll do a transfer first, and then they'll finish up the cash. If you do that, that stock transfer goes in as a partial withdrawal because the person's still a member at the end, and you don't get the benefits of the full withdrawal property transfer. Okay, so if you're going to do that, make sure the very last, that the stock gets transferred in the very last withdrawal, and it's a full withdrawal. Don't split them up.
That's a great something to keep in mind when clubs are disbanding. That there are some specific rules that you should be following at that point. There are a couple of tax consequences. Whether you sell shares, transfer shares, or pay cash really has little impact on the withdrawing partner. The IRS is going to get their gains one way or another, but the smart moves really benefit the remaining partners, including transferring highly appreciated shares, so you really want to understand how that works. And selling depreciated shares, which I think it gets underrated. People tend to hold on. We're very bad individual investors, and clubs are bad at selling stocks, and this is a great way to clean up the portfolio. Dumb moves would include selling appreciated shares to fund full withdrawals or transferring depreciated shares for any withdrawal. There's just no good reason to do that in any circumstance that I can really think of. Otherwise, there's not much that you can do to manage the taxable impact. The taxes are what the taxes are. When we talk about well, let's just keep going through. We'll talk about entering withdrawals in My iClub. We'll step through these pretty quickly. These screens are pretty straightforward. We're going to actually working on some cleanup on some of these screens, adding a little bit of help to them. This is a cash plus stock withdrawal. So we have a withdrawal type of full. We have the announcement date and we have the payout date. They can be the same. It depends on how your club works. There's a box to check if the user is withdrawing stock. We click continue and they say, all right, so here's how much this member had. Here's how many units. Is there a penalty? Is there a withdrawal fee? Here's how much the member is due, $223.75 in this case. So we've decided we're going to transfer some stock. So here's the club's portfolio. The club, in this case, decided to transfer 4 shares of their Fastenal stock, which was valued. The full share value was $190, so it wasn't enough to give 5 shares, but 4 shares gets most of the balance there, and that remains $33.51 in cash that has to be paid out. So the club would go ahead and click submit, and here is the where we are able to select lots. So if you have the capability, you can, and you have multiple lots of stock, you bought the stock multiple times, you can select them. In this case, there's 1 lot, so we just select 4 shares from that lot. We click submit, and the transaction is complete. We've got a report here, a full report that's got all of the information on it. I will point out up here that you can print a PDF of this screen as well as email it to members of the club or any of the members. It has all the details that you want to see on it. When you print out, and then from here we want to go and print out the withdrawal report. And so that withdrawal report looks like this. It's got almost everything that that the member needs to know about their tax basis in the club, what the adjusted basis, the club's cost basis, the fair market value of the stock, and the partner's adjusted basis. And when you look at this, you see here we have the amount the member withdrew, $223. They received $33 in cash. The value of the stock was $190. The tax basis in the club was $175. So that's what the club, how much this member's tax basis. They had put in $175. In other words, there were no earnings or loss this year, so that $175 was their basis. They got back $33.51 in cash, which left them with $141.49 as their adjusted basis in the stock. And that is the amount right here that is now their basis in the $190 worth of stock that they received as part of their withdrawal. So did I get that right, Russell?
Yes, you did. Right on.
Everything is there. So when James here sells that Fastenal stock, hopefully at some point down the road, it'll be worth $200, or it'll be $300, it'll be $400. And when it comes time to calculate what his value is, well, the club paid $190 for the stock, but his basis, his cost basis is $141. So if it's $400, he'll have roughly $260 worth of capital gains on which he's going to pay taxes. So the software calculates all that. It's just important that we understand how is that working that way.
I have one little thing to add here. When they're actually sending the message to the broker to transfer the shares, you notice that it gives you which lot it came from. Now this one's not a big deal because it's only 1 lot. If you have multiple lots, then you can instruct the withdrawal report. You can tell them I want to do 10 shares from the lot purchased on 6/13/08 and 10 shares from the lot purchased 9/10/09. So you can tell them specific lots. If you don't tell them, they'll do a first in, first out.
When we, yeah, that's, again, the instructions you provide your broker need to incorporate that. The withdrawal scenario calculator, we have this on the My iClub website. It allows you to calculate the appropriate scenario whenever you've got a member that's withdrawing from the club. So we go to the member section here. We look at the withdrawal screen. We have a link to the club member withdrawal calculator. So here we select a member of the club and we decide, is it a full or a partial withdrawal? And then we calculate the best possible scenarios for that member based on the club's securities that they have. So in this case, Richard has $3,881 in the club. The first thing to look at, because it's a full withdrawal, is transferring appreciated securities. So we look at your club portfolio and we say, well, gosh, here are the stocks that you own ranked by the amount of capital gains over here in the last column. So in this case, we've got a massive capital gain in O'Reilly Automotive, $27,000 of capital gains, it seems. The stock has performed really well in the many years that we've held it. So the thing here is we could sell $3,881, or we could transfer $3,800 worth of that stock, and we could reduce the amount of capital gains by a couple $1,000s there. The second one is selling the losing stocks to raise cash, and so we have some stocks with a lot of capital losses, so here's a great opportunity to get rid of some of those and raise the money. And then to pay off the cash, if we don't have enough cash in our account, it tells us, so we might have to figure out what to do. And then it says don't. Here are some not unrecommended scenarios. Selling appreciated securities, for instance, that would not be a good thing. But if you were going to sell appreciated securities, sell the stocks that had the least amount of capital gains. You don't want to generate capital gains unnecessarily. And so they're ranked in the other way. There's also a link here to an article that outlines some of the best practices for member withdrawals. So this tool is really unique to My iClub, and you can print this out and you can provide it to your club members and use it as a way of discussing best way to handle withdrawals. I'm going to make a note here. We don't have the a little PDF icon or print screen here that would be useful for this particular report. That's something we can add in at some point. So very quickly, we want to talk about tax matters. I know we're running a little bit late. We're going to run through this kind of quickly. As you probably know, general partnerships are pass-through entities, which means that all the taxable transactions throughout the year are distributed at year-end to the partners and have to be reported to the IRS, and in some states, not necessarily all states. For withdrawn members, however, the withdrawal report is provided and has information that doesn't appear on the K-1. So you have to make sure at year-end that you provide the K-1 to withdrawn members, as well as it's a good idea to send them a copy of their withdrawal report as well. Withdrawing members have two tax matters to consider. They got to report their share of the club's gains and losses and income and expenses to the IRS on their personal tax returns up until the point at which they withdrew. And then they have to report the capital gain or loss, the difference between the market value of their club interest and the tax basis of their club interest. So how much they put into the club and then how much they took out. So they've got a withdrawal or a amount of capital gains or losses that they're going to have to calculate and report there on their own. As we said, the withdrawal report includes the tax basis that I stepped through, the member's capital account, and they'll have that K-1. So they need both of those forms for their personal tax return. It's really key that they've got both of them. Here's that withdrawal report once again. Can't emphasize that enough if you're the treasurer to make sure that that happens. Now, in the case of a partial withdrawal of cash, you can take money out of the club because you put money into the club, and you can take out as much as you've put in, which is your paid in plus earnings, the amount that you've put in and the amount on which you've reported to the IRS has income in past years. That's the paid in plus earnings, or PIPE. Any amount that you withdraw up to your PIPE is a tax-free return of capital. So there's no reporting to the IRS on it. You're just taking the money out that you put into the club account. There's no gains or losses to it. If you withdraw in excess of your club PIPE, then that's a taxable capital gain and is reported by members on their personal tax return.
I just wanted to add, partial withdrawals have a little complication in that the member's basis is always determined at the end of the year. So it's possible for you to overdraw your capital account and have what may be a capital gain. But if you put more deposits in and build up your capital account again past what you took out, it becomes tax-free. You don't have a gain at the end of the year. So it also means you have to look at the allocation report at the end of the year if there's been a partial withdrawal to get the true possible gains from a partial withdrawal.
In the case of a full withdrawal, again, if it's less than PIPE, it's so you withdrew, your club didn't do very well, in other words, and you did a full withdrawal and it was less than you put in, that's a capital loss. So it's important to know that. You can use that to offset other gains that you made. And the Schedule K1 is going to have other reportable numbers from the club's activities. In the case of a partial withdrawal of securities, then the club's tax basis in the transfer security becomes the member's tax basis in securities. And then the taxable event is only triggered when the member eventually sells those shares. So we've got a tax basis that comes along with the stock that's transferred in the case of a partial withdrawal. Again, one of the reasons why you might not want to look at withdrawals, look at transfers of stock for partial withdrawals. It doesn't always have a lot of advantages. But the advantage to the club, as Russell pointed out earlier, is that to the member rather, is that if they hold on to that stock for 10 years, then they don't have a capital gains liability to worry about until 10 years later. For full withdrawal securities, as we pointed out, the withdrawing member's tax basis in the club becomes the member's tax basis in the transferred securities, less any cash that's paid. So again, the taxable event only gets triggered when the member eventually sells those shares. So it could be 10 years down the road. And interestingly, the holding period includes the club's holding period. So if the club owned the stock for 2 years, the member could own it for 2 days, sell the stock, and it would be a long-term capital gain. So again, just another reason why this full withdrawal transfer of securities option seems to work really well. Just keep in mind that member withdrawal report's got the tax basis, gain loss, and all the good information that you really need to know, that withdrawal members need to know. It's not available anywhere else, so make sure that withdrawal members have that. One other withdrawal issue that we get a lot of questions, what is the WD liability? This is the withdrawal liability account. WD stands for withdrawal, used in the two-step withdrawal where the withdrawal is valued on one date and paid at a later date. So when you do that, use that two-step withdrawal process, well, the amount of the payout is known, and now it's a liability the club has to pay. So it shows up on your financial statements as a liability, as a withdrawal liability. And it's meant to indicate that you have an unpaid withdrawal that you need to process. Don't use that money for something else because it's not going to work out. Well, I think we've covered a lot. I know we ran over a little bit, but there's a lot of information with regards to our member withdrawals that we wanted to cover there. Russell, did you have any final comments on member withdrawals that you'd like to share with our attendees?
I just want to reiterate about partial withdrawals. For those, remember, give the member also the allocation report at the end of the year, your income and expense allocation, because that will have the final capital gains on it. It probably won't be on the withdrawal report. Matter of fact, if you look at it, it probably says you have to look at the allocation report to get the final amount.
Yeah, that's really key to be able to share that the allocation, the K1, and the withdrawal report in the case of withdrawing members have to be provided. Maybe there's some better ways that we can accommodate that in the year-end tax preparation. We do cover it in our year-end closing the books webinar for sure. I think that's it. There's a couple. I don't see any other questions, so we're going to go ahead and wrap it up. I wanted to thank Russell and Jim Thomas, who provide some good feedback on this presentation, and the Puget Sound chapter has a concepts guide that they published for club accounting that's got some great information in it as well. I want to thank you all for coming tonight. Remind you that My iClub is our primary tool now for investment club accounting and operations. We've been working, we've got a whole lot of little enhancements we've been releasing in the last couple of months. So if you haven't checked out My iClub in some time, you might want to give it a little overview again, because we've got some nice reports that we've added and some additional functionality. We're trying to continue to make it easier for club treasurers and investment club members to use to make sure their club's books are handled accurately and smoothly without a whole lot of complication. So thanks again, Russell. Thanks to all of you for attending tonight, and we'll look forward to seeing you at our club webinar in November here at iClub Central. Thanks again.
Good night.